This year, I've been able to make multiple six figures trading, and the crazy part, those trades weren't stressful, they weren't impulsive, and I wasn't staring at 50 plus indicators. They came from one thing, and that one thing was clean price action. So today I'm going to be breaking down the exact process I use every single day, why price action matters, how to identify true versus false breakouts, how to read candlestick confirmation at key levels, how I use Fibonacci plus supply and demand to pinpoint the best entry, and why volume at those levels tells you the truth behind the move. So by the end of this video, you'll understand the logic behind my trades, not just the pattern. So if you do find value in today's video, make sure to smash that like button, but also make sure to hit that subscribe button. I have like 1,400 plus videos teach you guys on how to trade for completely free here on YouTube. And I also live trade the New York market open every single day. So subscribe, but let's hop into it. All right, so before hopping into how to use fibs, read breakouts, supply and demand, candlestick entries, etc., you need to understand one thing. Who is controlling price? Buyers or sellers? The market only lives in three different phases. The first one is going to be an uptrend. So if we were looking at price the other day, it's very strong to the upside. This is going to be an uptrend. An uptrend is where buyers are in control. There's higher highs, higher lows, and clean stair-stepping structure. And every time that price pulls back, it gets bought back up. Second is going to be consolidation. So if we were to just look in the overnight price action right here, nothing is happening. Price is stuck between two levels, which would be this low and this high. Consolidation is an area that's a perfect place to build liquidity. And we'll come back to that when we talk about supply and demand. And there's a lot of false breakouts that happen in this consolidation. And then third and finally, what we have is a downtrend. A downtrend is where we're getting lower lows and lower highs, and every single pullback to the upside shows that sellers are stepping in and pushing price lower. Now, the reason why this matters is very simple. You never want to buy into supply, and you never want to short into demand. It's very easy to understand that. This is where beginners blow accounts, and knowing the trend phase tells you what kind of trade you should even be looking for. So first, I want to talk about true versus false breakouts. Breakouts are powerful, but they're also one of the easiest traps to fall for. So here is how I filter them. Step number one is a structure break. You need to be looking for price to break above a key level or below a key level with strength to indicate that price is likely actually going to break. Step number two is you need the candle to close above or below the level. Wicks do not count. Wicks mean nothing but liquidity grabs. A real breakout needs a strong body close. So for example, today we had a breakdown below pre-market lows right here. Now, as we can see, we had multiple candles break below this level, showing that the breakdown was truly valid. If we were just wicking below that level and bouncing back up, that is not a trade that I would look for. Again, we need to have candle closes on the breakout or breakdown to confirm that they're actually valid. And step number three is we need to have a retest and a hold for confirmation. Typically, when price does break down or break out, we will have price come back and retest that breakout zone. So for me, this is an actual trade that I took today to the downside on the S&P futures. We broke below that pre-market low with strength, validating that the breakdown was true. From there, I was looking for price to come back up and retest this area. And as it retested and started to reject, that is when I went short and was able to capture a nice move down. But when price does retest the level, you want sellers in this scenario to show that they're actually at this area. If price doesn't reject hard, it doesn't wick aggressively, then there's no trade. But as we can see in this example, we rejected off of this zone multiple times, which again gave a very high probability short entry. So when we get these breaks and retest, if we break below support, it becomes resistance. If we break above resistance, let's just pretend that this is a resistance point. But when we break above resistance, it will likely become support. So again, break below support, it will likely become resistance. Break above resistance, it'll likely become support. Now, what you need to be careful of are these false breakouts. False breakouts typically lead to traders jumping the gun and just getting stopped out and taking a stupid trade that they should have avoided. So what you will notice when we have false breakouts is a quick pop above or below the level, but it will quickly pop back up and reclaim. So again, we're just going to make up an example right here. Say we had a support zone. You were looking for your 30-minute orb, 15-minute orb, whatever it may be, and you're looking for price to break below this low right here. Well, price did break below this low right here, but if you jumped the gun and you did not wait for candle confirmation, you entered short and just got stopped out as price reclaimed the area. So again, that's why it's very important to always wait for a candle close and wait for the actual confirmation before taking the trade, because traders get faked out because they chase the breakout candle instead of waiting for that basic confirmation. So now that you know how to look for a valid breakout versus a false breakout, next I want to talk about supply and demand as well as Fibonacci retracements. This is where trading becomes 10 times more precise, because when you start using supply and demand as well as Fibonacci retracements and piecing it together with confirmation candles as well as volume, your confidence becomes way higher and your accuracy goes way up. So let me break this down for you. Now, personally, for me, when drawing supply and demand zones, I like to use Thinkorswim. I just personally think that Thinkorswim has the best possible data when it comes to plotting supply and demand. And now I have tons of videos also on my channel breaking down exactly how to use supply and demand as well as plotting it. So I will be leaving those links down in the description. But a demand zone is where aggressive buyers have previously entered. When price returns to its zone, to its demand, I want to see a strong bounce, a bullish reaction candle, as well as volume increasing. A supply zone, however, is where previous aggressive sellers stepped in. So when price returns to supply, and I'll show you a trade that I took yesterday for 100 points on the NASDAQ futures, but when price returns to supply, I want to see rejection, bearish confirmation candles, as well as the volume increasing on the rejection. So yesterday I ended up taking a reject, and I think it was based off of the 4-hour supply zone that we had right here. I do all this live. It was on my YouTube channel. I called the trade from start to finish, but we have this big move down. Look, one candle to the left, we have this small green candle. So what we want to do is mark the lower wick of that green candle as well as the open of that green candle. Now, when price returns back up into that area, I'm doing this on ES, I took the trade on NQ, but same thing, we have this 4-hour candle right here, small green, big red down. We're looking for price to pop back up into this area, and we're going to be looking for a rejection. So now if we break it down to a 5-minute time frame and we go to yesterday, I want you to notice what happens when we get up into this area. We have a very large and aggressive move to the upside, which is what I really like to look for, and we start rejecting off of this level. Now, as far as the volume increasing, I will say it is subjective depending on how big the move is into the key level, because again, we moved 300 points into this supply zone, which is a very big move up. So there was a very high probability that price would pull back. Would I have liked to see more volume on this candle? Absolutely, but price was going up off of lighter volume. So we go up into it and we reject it right here. We have a nice upper wick. We try to pop up into there again. Guess what? We rejected right off of it. I was using order flow as well at this time. Ended up going short at like 30, which is somewhere up here. Stopped right above this high, and I was able to capture a 100-point move to the downside right here. So again, this goes to show that trading is actually very, very easy as long as you have a profitable strategy and you know what to look for. But candlestick confirmation absolutely helped with this trade because it gave me a reason to go short. If we had candles like this going into the supply zone, I would not be shorting it. Or even today on the basic break and retest of that pre-market low, like I already showed you, here's our previous low. Price breaks below, comes back up. Well, what do we see? Rejection candle, rejection candle, rejection candle. That's enough confirmation to go short. And as we see, price rolled over and went to a new low a day. And this is why I also say that none of my trades are stressful. I have my strategy and I wait for proper confirmation. If it works out, awesome. If not, I know my risk management. So now I want to talk about candlestick confirmation. Again, I have a ton of videos on my channel about supply and demand as well as Fibonacci retracements, the full breakdown. So I will be leaving those down in the description. But the most important at any key level is going to be candlestick confirmation. And this is the part that most traders ignore. You can have a fib level, you can have a supply zone, any key level, but if the candles do not confirm, the trade is invalid and you do not take it. So here is how I read candlesticks. So this is my 3 candle confirmation sequence that I use every single day. Going back to yesterday's NQ trade, if I am looking for a bearish reversal at supply, a Fibonacci retracement, pre-market low, whatever it may be, I want to see a push into the key level. Typically for me, I've noticed a stronger push into the key levels makes a higher probability that price is going to reverse. So typically I would like to see this. Not are we going to get that all the time. Second, I want to look for a rejection wick. And third, I want to see a bearish body close. So again, we have the long wick going up into the level. If you were using order flow, you could have seen that there was a lot of sellers up in this area, which also added to the confluence. But on this big move up, what this shows me is that buyers are tired. As we hit the key level and we start rejecting, that's showing me that sellers are absorbing the buyers. And finally, that sellers took control. So to me, this was a perfect short. Same thing today if we go back to the ES example. Nice little flush down, we pop back up, and what do we notice? We have an increase in volume and a long upper wick right off of this previous low. So what is that telling us? Sellers are taking control. Sellers are absorbing the buyers into this previous pre-market low. Sets up for a high probability short. If we're looking for a long position, it's the same thing but flipped upside down. So what I ended up having was a Fibonacci retracement from somewhere over here, this pivot low to this pivot high. This is a trade I took a while ago, but we trade down into 61.8. What do we notice? Buyers are there. If I had the volume turned on, you would also see in the volume that the buyers were absorbing the sellers. As we can see, every time we pop down into that 618, this white line right here, it got bought up right away. So it does it here, boom. Does it here, boom. Does it here, boom. So again, what's happening? Price pushed down into the level. It was a pretty large push back down into the 618. We had this bottom wick right here pop down and pop back up. We had the order flow also confirming, and price closed above the 618. So again, a perfect long entry. So now I want to finish off this video with why volume is the final confirmation. I will say volume is not always going to be there. Ideally, you would like it to be there, but again, every trade is not going to be picture perfect. It really depends on the different scenarios. But ideally, you would like to see the elevation in the volume because the volume tells you the truth. Indicators can lie, price can fake you out, but volume rarely does. So whenever we hit a key level, whether it be a resistance zone, supply zone, whatever, reject zone, you would ideally like to see a bearish candle with an increase in volume. Reason being, that is going to show you that sellers are taking control at that rejection zone, and vice versa. If we came down to a key level, demand zone, support, Fibonacci retracement, whatever, ideally you would like to see a bullish candle with an elevation in the volume. Again, sometimes it's not going to be as clear cut. Sometimes you got to read a little deeper into the price action as well as the volume to get a better understanding of what's happening. So that's going to wrap up this video. If you did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. And again, make sure you guys go and watch those supply and demand as well as Fibonacci retracement videos. I will be leaving those down in the description. Other than that, everybody have an amazing rest of your day, and I'll see you guys in the next video.